If you take the M2 money supply, and that is what I think is probably a better designation, $184,000 gold. And again, this is Van Eck saying if this were to happen, the Genius Act is a law that was passed. It goes into effect January 1st, 2027. And what it says is that from that point forward, you'll never use checks and wires again, ever. It's gone, bye-bye. It means that any time money moves, ever, whether you're buying a pack of chewing gum or a new house. President Trump said to me, July 4th, 2026 is the biggest day of his presidency. It's the 250th anniversary of the country, and he will back the back end of the bond market with gold. Broke, we're insolvent, we're uneducated, and AI is going to hurt it. I don't know. To me, that's what I focus on, is that people at that level don't do this for the hell of it. And you go back to 2019 when the BIS, Bank of International Settlements, which is the central banker's central bank, quietly, gold is now a tier 1 asset. Oh, it is. Yeah. So, it's like the world doesn't understand that gold is a tier 1. The world doesn't understand that the BRICS nations have in essence created it as a de facto settlement system where currency imbalances and trade imbalances are now going to be set and are already starting to be set in gold, settled in gold. And they don't understand all of the big macro pictures because in essence, the financial media focuses on less and less until they're experts on nothing. And it's crazy to me that there isn't any talk about what is happening, not only to the value of the dollar, but what is happening to precious metals, and why are we seeing the biggest money in this country stand for delivery? What do they know that we don't? And that's what I've been trying to scream about for the last 5 years, but more so in this. And by the way, go back to 2020, when I started screaming on every podcast that someone is standing for delivery, the Commitment of Traders report on COMEX is forever 2 categories: the specs, which are the hedge funds, the commercials, which are the banks. And it would publish the positions of the biggest traders. One would go long, the other would go short. And then out of nowhere in 2020, they put a third group in there. Out of nowhere, they called it the others. Who the hell are the others? We believe them to be sovereign wealth funds who started taking delivery in 2020. The central banks have been buying gold off the hook since 2 years before the BIS classified it tier 1. I wonder if they knew something that the rest of us didn't. And then they all started to do something interesting. The majority of the central banks out there started to repatriate their gold from the Bank of England and the New York Fed, which gave direct access to the LBMA and the COMEX. And so it started out with Germany saying, give us our gold back, Bundesbank. And then within a few months, you had the Bank of Austria, Hungary, Turkey, Poland, the Czech National Bank. All of these banks said, give us back our gold. That was 2017, 2018. Those banks together bought more gold as a group than they did in the 60 years previously combined. 2019, that number was doubled. And all of a sudden, isn't it interesting? The BIS calls it tier 1. 2020, it started coming here. And we started to see deliveries off of COMEX. And I'm like, this is weird. There was never anyone standing for delivery, but it wasn't to the degree like we're seeing now. What we see now is way, way off the charts. And just ask yourself, at this level, the people who are spending that kind of money, do you think they know what's coming? I would argue they do, just like the central banks who started buying off the hook 2 years, first repatriating their gold from the Fed and the Bank of England, and then going on a wicked buying spree, and then just coincidentally, BIS calls it tier 1. At this level, information is everything, and they are front-running what is coming.
Andy's dropping a massive hint here. The central banks and sovereign funds aren't just buying gold for safety. They are front-running a known event. They know the rules of money are about to change. If you want to stay ahead of this global reset and protect your wealth, make sure to like this video and subscribe to our channel right now.
I believe that in my soul. They don't do this for the hell of it. And I think that's the macro side that I focus on. And then I look at everything within it and try to put it together as to make sense.
What do you think is coming? I mean, what is your hypothesis then?
Well, I mean, I don't know that you really want, I mean, it'll take me a few minutes to do it. I'm happy to tell you, but what I am basically, look, here's the bottom line. You got the Genius Act, okay? The Genius Act comes into play no later than
Explain the
January
Genius Act for people who may not understand what the
So
Genius
the Genius Act is a law that was passed. It goes into effect January 1st, 2027. And what it says is that from that point forward, you'll never use checks and wires again, ever. It's gone, bye-bye. It means that anytime money moves, ever, whether you're buying a pack of chewing gum or a new house or anything in between, it will be moved via stablecoin on a blockchain network. It settles like that, like Venmo or Zelle. The stablecoins that will be the rails are backed by something. U.S. Treasuries, short-term U.S. Treasuries. So anytime money moves, if I owe you $1,000 and I send it to you, a stablecoin is created. When you receive it, stablecoin is burned. Backing that stablecoin are short-term Treasuries. Now, the first thing that does is drive down short-term interest rates synthetically and create demand for Treasuries synthetically. That's what runs the government. And not only that, it gives demand for something that is losing demand. And how do you keep rates low? Synthetically, which got us in this problem to begin with. Anytime money moves, you do that. Now, who's the primary benefactor of this? There'll be a lot of corporations and institutions that will issue stablecoins, all of them backed by Treasuries. But the primary benefactor is USA Tether, an offshoot of Tether. Their CEO, coincidentally, is a man named Bo Hines. Bo Hines was Trump's crypto czar through August. Now he's benefiting from the rules that they put into place. Now, the interesting thing about all of this is that the interest on said treasuries is not transferable to you or me. Now, that makes the banks happy because people would want to get stable coins then. Instead, Tether keeps it. What has Tether been doing? Well, they have $14 billion in gold, the largest stockpile of gold in the world outside of central banks. Now, why would that be relevant? Go back to 1933. When Roosevelt confiscated gold at 20 bucks an ounce, what did he do? He immediately revalued the dollar or devalued the dollar by 40%, making gold 35. When you talk about how is a currency valued, it's not the Dixie Index that we are taught to believe. Dixie Index is a flawed measuring stick because of something called Triffin's dilemma, which is the economic term that says as the reserve currency of the world, you will always run a trade imbalance because we cannot give the world enough in the way of dollars, period, through trade alone. So they have to, in the open market, in essence, buy our currency and sell theirs. So they're constantly devaluing against our currency so that they can conduct global business, let alone have strong manufacturing. That creates an imbalance. And over time, this imbalance, your manufacturing goes to places like Vietnam or to China, or Mexico, other places where their currency is weaker. All right, Vice President Vance has recently come out and talked about this. He said, we can't do this anymore. It's destroyed our manufacturing. He wrote about it on White House letterhead. Jared Bernstein, true knucklehead, tried to explain how treasuries were sold and created. He was the economic advisor, lead through the Biden administration, wrote a report called Dethrone King Dollar, advocates the same thing. It can't be the reserve currency anymore. All right, so here's how I'm gonna put it all together for you. So the Genius Act suppresses interest rates in the short term. Anytime money is moved, the interest is now being put into gold. What does that do? Pushes gold higher.
This is the mechanics of the Genius Act. By forcing stablecoins to hold U.S. Treasuries, the government creates artificial demand for its debt. But the twist is using the interest to buy gold. It's a stealth way to devalue the dollar while the Treasury quietly accumulates the only asset that matters.
Right.
Wickedly devalues the dollar. What would be the first thing you would have to do? Better reshore the gold. Say it's tariffs. No, it ain't. They're reshoring all the gold. So now you got all this gold, right? And the more gold that Tether continues to accumulate, do you think that Bo Hines and Trump have some sort of an agreement? Now, here's where there's a little bit of speculation. My feeling is, yes, they do, that the Treasury will end up with that gold. But let's just take it one step further. Judy Shelton comes on my show, and she says, Andy, in no uncertain terms, when I was on the transition team, President Trump said to me, July 4th, 2026 is the biggest day of his presidency. It's the 250th anniversary of the country, and he will back the back end of the bond market with gold. Now, why would he do that? I'm going to put it all together for you. You know, Ray Dalio just came out and said 60% of the United States has a literacy rate below the 6th grade. We're uneducated. $38 trillion debt plus $180 trillion in unfunded liabilities, Medicare, Medicaid, Social Security, government, military pensions. You know how long ago a trillion seconds was? 31,688 years ago. That's a trillion seconds. We're broke, we're insolvent, we're uneducated, we don't make anything anymore. Where's all our manufacturing? Griffin's dilemma threw it across the globe.
Right.
And guess what's coming around the corner? Mr. AI, that's going to kneecap not only entry-level jobs, they say 50% of them within a few years. My son was an accountant for Price Waterhouse. He works here now. He was analyzing a balance sheet of real estate investment trust, getting paid 80 grand. What do they need him for when an AI can do it like that? All right.
Yeah.
So we're broke, we're insolvent, we're uneducated, and AI is going to hurt us, right? So how do you bring back manufacturing? Griffin's dilemma says, well, you can't if you're the reserve currency. Vice President Vance says we can't be the reserve currency anymore. So what do? They create the Stablecoin Act, suppress front short-term interest rates to create volume in loans and whatnot. All of the proceeds go into gold, pushing the price higher, 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 higher. The dollar goes lower, 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 lower. We can pay off our debt. We can sell manufacturing to the world. How do we get the manufacturing back? Judy Shelton says we'll peg a 5, 10, 20, 30, and even a 50-year bond. All of them except the 30 and the 50, zero coupon, zero interest rate, redeemability in gold. The more stupid you are with fiscal policy, the higher the price of gold goes. But that's what they want because that devalues the dollar. So you're another country. You said, I don't want your treasuries because not only have you sanctioned against them, but you're fiscally irresponsible. You're creating $1 trillion in debt every 100 days. Why would I want it? How about it's redeemable in gold? You get the gold, not our interest rate, which is fugazi. Okay, I like that idea. So in 20 years, I owe you $100 million worth of gold. Okay, fine. I'll buy it. Let's do it. Okay, now you bring back your manufacturing at zero upfront borrowing costs.
This is the Judy Shelton plan in action. By issuing a zero-coupon bond redeemable in gold, the U.S. can borrow money for free today and pay it back later with a devalued dollar. It's a strategic soft default designed to trick the world into funding America's reindustrialization.
Zero, because it's redeemable in gold. And every time money moves anywhere across the globe, it provides synthetic demand for the Treasury market, and the interest is going into gold, which pushes it higher, 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 the dollar lower, lower, lower. You now have the ability to pay back that bond in far fewer ounces of gold down the road and bring back manufacturing, because if we don't, our children and our grandchildren are in very, very, very big trouble. Anytime any country has ever crossed 130% debt to GDP, they have either hyperinflated or defaulted. And the only reason Japan may be able to pull it off is they're not the world reserve currency. They have the largest level of savings on the planet, and they have a massive trade surplus. And they're trying to straighten out their act right now. Bottom line is simply this. My thesis is, how do you bring back manufacturing? You do so in a zero interest rate environment, and you use the rising price of gold to devalue the dollar to, in essence, soft default on the reserve status, so our children and our grandchildren will have a future. Now, the only side effect of all of this is your universal basic income. And that will happen because you're going to get a K-shaped economy where the rich get richer and the poor get poorer simply because of all of this. And it's going to be much more difficult for a period of time. You're going to destroy the value of the dollar. And the rich get richer through the Cantillon effect. Closest to the money, they buy assets. Their assets go up. They don't care about the cost of living. People who don't have assets down here, they're having a harder time putting eggs and bread on the table. And, you know, with what AI is doing and all of this stuff, it's going to make it very difficult for the people who don't have assets, and the dollar is going to lose value. So until we get to the point where we can actually talk about growing our way out of this problem, bring back manufacturing, if not, we're dead. And I think that is where the nobility in what President Trump is trying to do quietly. And I've been saying this for about 6 months, and everything seems to be going down the line. Now, maybe I'm wrong, but I don't think there is no way that we can just grow our way out of a problem with no manufacturing base and AI and artificial intelligence and robotics kneecapping what are many, many industries along the way.
It's a terrifying reality. With $38 trillion in debt and an AI revolution about to wipe out millions of white-collar jobs, the U.S. economy is cornered. Andy argues that without a manufacturing base, the only option left is to radically devalue the currency to survive.
That's a really interesting thesis. Just devaluing the dollar in order to bring basically any kind of manufacturing back to the U.S. That's an interesting thesis. But here's a follow up to that. With these new macro dynamics you're talking about, like the Treasury bonds being possibly backed by gold. I mean, how high does gold prices need to go before the government books are back into balance?
Well, it's an interesting question that you would ask that. I mean, there are a lot of people out there. James Rickards has been talking about, I think he said $24,000 an ounce gold, but there was just a report that was done by, I think I have it. Oh, geez, I should have had this sitting out there. Here it is right here. So there was a report done by Van Eck Funds, and it's titled, "If the Dollar Loses Reserve Status." Ironically enough, I read it just the other day. It says, what if gold is replaced, blah, blah, blah. And it says, I'll just read what it says real here. What if gold is replaced by the U.S. dollar as the reserve standard? In this paper, our emerging markets bonds team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to a $184,000 per ounce metric. If they use central bank MO, which is just money liabilities divided by gold reserves, $39,000. And this is Van Eck Fund. This isn't my number. If you take the M2 money supply, and that is what I think is probably a better designation, $184,000 gold. And again, this is Van Eck saying if this were to happen, this is what you would be looking at. I'm not saying it's going to happen. All I'm saying is, if you took M1, it's probably closer to $24,000, and that's James Rickards' number. And it's ironic, too. Do you know that in almost every central bank balance sheet, gold is held in what is called the gold revaluation account? Now, could they just revalue it? Sure, why not? Roosevelt did it in 33, and Nixon did it in 72 and 73. The gold window was shut at $35 an ounce in 71. He made it 38 in 72, which devalues the dollar, and made it 42.22 in 73, devalues the dollar, where it stayed on the books until today at 42.22. Even if he marked it to market, he could do so, because every $4,000 increase in the price of gold gives the Treasury Department $1 trillion free and clear. So you put gold at $184,000, you've just filled the Treasury with reserves that they could pay off the debt, start doing things. In other words,
did you hear those numbers? Van Eck is projecting gold could hit $184,000 per ounce if it backs the M2 money supply. This proves that central banks have a get-out-of-jail-free card, revaluing their gold reserves to wipe out their debt overnight.
I think they realize it. Look, the head of the Bundesbank has been advocating for this, as has the head of the Dutch National Bank. Everyone has gold at absurdly low levels, the way that used to be prior to with the Bretton Woods Agreement. And they all realize that gold is an option to kind of balance the books and get things in order again. And who would it benefit? The majority of the central banks on the planet, who've been buying it hand over fist since 2017. But I'll say it again. My mentor, Richard Russell, used to say years ago, the Fed is trapped, either they inflate or they default, which is the path that all central banks have taken. Maybe this is option 3, a soft default on the reserve status to give credibility to the bond market, which is really what's important, because there's a waning demand for our treasuries,
right,
to bring back manufacturing and just simply say, thanks for the fun, guys. It was a real privilege to keep interest rates low and goods cheap, and that's the benefit of being the world reserve currency, but we've squandered it with our indebtedness, and we're not in a good position financially or in terms of the infrastructure of the country. Are we educated? Do we have savings? What about AI? All this stuff is against us. If we don't throw a Hail Mary, honestly, I think the prospect for the world our kids are growing up in is rather scary. The opportunities are disappearing into a wave of massive efficiency in AI and robotics at the expense of millions of jobs. It has to be done.